Today, lucky dividend investing viewer, I am showing you why I bought another share of my #1 individual stock and the simple metric that made this a no-brainer decision. And if you're tired of trying to decide what stock might be undervalued, please stick around because this really could change your investing approach. But before we dive in, I need to introduce myself. My name is Russ. What's up? I am a welder who is passionate about passive income, and I'm sharing with you what I'm learning and how I'm evolving here on YouTube. By the way, I have a free and fantabulous weekly newsletter where I share an investing thought, all the portfolio moves, and some stocks about to go ex-dividend for the coming week. And I also want to mention a Seeking Alpha affiliate link in the description below where you can save a bunch of money on an annual subscription and get access to great stock research tools and tons of analyst opinions. So we're going to talk about free cash flow yield, why it's important to you, and how super easy it is to calculate. Honestly, if I can calculate it, you can calculate it. All that you do to find the free cash flow yield is take the free cash flow per share, divide that by the current share price, and multiply it by 100. Now, if you're frugal like me, you'll know the saying, if it's free, it's for me. And here, I'm going to show you the super simple way to find free cash flow yield on finchat.io. Clickety-clack dashboard. We'll go with my Nexstar Media group that I just bought, ticker NXST. You'll be whisked away to the summary page, but we're not going to stay here. We're going to click on financials, and in financials you'll have access to the income statement, the cash flow statement, and the balance sheet, but they're only going to give you the last 5 years. But we're going to hit ratios, and on ratios scroll down just a little bit until you see the free cash flow yield. Right there, all the way to the right, you'll see the last 12 months for Nexstar is currently 22.7%. But Russ, you say, what does that mean? Well, the free cash flow yield tells you how much cash a business generates compared to what you're paying for it. Now, this matters because investors far smarter than I like to compare this to the 10-year Treasury yield, which as of this recording is about 4.5%. Now, this Treasury yield is what is considered the risk-free rate. And by risk-free, we mean that the US government is always going to pay its debts. And if the US government isn't paying its debts, you're going to have much more important things to worry about than your stock portfolio. Now, if we're using this metric when we buy a stock, we want to make sure that we're significantly above the risk-free rate. And a lot of investors like to be about 3 to 5% above. Now, if a stock has an 8 to 10% free cash flow yield, I get pretty excited, but I get really excited when I see something with a greater than 20% free cash flow yield. So this is a chart I made to kind of help visualize what a free cash flow yield comparison might look like. And I made this on April 9th at about 11 a.m. And it happened to be just before the 90-day tariff pause happened and stocks shot up. But I was kind of trying to think about what do I want to buy. Now you'll see there's stocks with a regular free cash flow yield. There are REITs that have an AFFO yield, and then some business development companies, BDCs, that have a NII or net investment income yield. So for REITs, we use an adjusted funds from operations or AFFO yield instead of free cash flow yield because it better accounts for their real estate business model and maintenance costs. And for BDCs like Ares Capital, ticker ARCC, we use net investment income or NII yield since their business makes loans and collects interest. And when we're thinking about buying, if we want to use this metric, we want to look for something that's sitting comfortably above the risk-free rate or the 10-year Treasury yield, which as of that chart I made was 4.38%. So everything in red was below. The ones in lighter green were just a little bit above, but not quite hitting that 3 to 5% range. And then everything bright green was obviously well above that, with the two clear winners being Ares Capital at 12% and Nexstar Media at almost 24% free cash flow yield, which is almost 5 times the risk-free rate. And the reason we're thinking like this is because any individual stock is inherently way more risky than a 10-year Treasury. So we should be getting compensated for taking on that risk, hence is why we want to buy something way above. But obviously this is just one metric. It's not to say that buying Visa below the risk-free rate is a bad investment at all. It's just to help visualize a free cash flow yield and something that a lot of investors like to use when they're trying to assess a position and if they want to buy it or not. But you better be pretty confident buying Visa, which I think they're a great company, that they're going to behave and perform very well because you are taking on a lot more risk than buying a 10-year Treasury. But obviously the share price of a 10-year Treasury isn't going to grow like Visa would. It's not going to increase that yield like Visa increases its dividend very, very quickly. So a lot of factors to consider. This is not a be-all, end-all. Now, as you can see here, Nexstar Media is my #1 largest individual stock position at 4.25% of my overall net worth. And if you follow the channel, I've been working toward getting my overall investment net worth. Again, this is not any savings accounts. This is not any 529 plans, the equity in my home, anything like that. It's just mine and my wife's investment accounts. I want this to be 85% fund exposure and 15% individual stock exposure. So we're working on it. We're making some moves here and there to get it there. But Nexstar is America's largest local TV station owner. They reach about 68% of US households. And some really quick points I like about them is they have 11 straight years of dividend growth with a 10-year CAGR of 27%. Management returns about 2/3 of their free cash flow to shareholders in dividends and share repurchases. The share count is declining due to their aggressive buybacks. Now, Simply Safe Dividends, you see here, shows 32.8 million shares outstanding, but it's actually 30.6 million according to the latest Nexstar SEC filing. And they have really strong free cash flow generation of almost $35 a share. Now, one bugaboo that I'm not terribly thrilled at is their net debt to capital is at 75%, meaning that of their capital structure, 75% is debt and 25% is equity. But as Leanne Gliha, their CFO, says that at a 20% plus free cash flow yield, buying back their own stock will deliver a far better return than paying down lower interest debt. And one potential catalyst is what CEO Perry Sook is pushing for and who has been actively lobbying on Capitol Hill to lift the FCC ownership cap restrictions. So currently, broadcasters are officially limited to reaching 39% of US households, but through some loopholes, Nexstar is able to reach more. And if those caps were removed, Nexstar would likely grow even larger through acquisitions. Now, I could be off my rocker, I could be completely wrong here, and I always say I'm either going to learn something or I'm going to make a lot of money. So either way, I'm looking at it as hopefully it's going to be a win-win. But I think about what Ben Graham taught Warren Buffett, who taught us that in the short term, the market is a voting machine, but in the long term, it's a weighing machine. Now, yes, Nexstar's stock price has moved sideways for 3 years while the company has continued to get more valuable because they're a cash flowing machine, they're reducing their share count and growing their dividend. Now, it's pretty clear the market is voting with fear that Nexstar is got a lot of hair and stink and could potentially be a hairy, stinky, melting ice cube because of the linear television shift that's going on with streaming and their industry. But the wait is that Nexstar's cash flow just keeps growing. So eventually the share price is going to rise to match the company's value, or they'll buy back so many shares that my stake will become more valuable. Somebody say stake? It's why they say investing is about the future, which is uncertain and unknown, but the past and present give us clues, and all that cash flow that Nexstar is generating gives me a pretty damn compelling clue. So here's what you can do. You can go ahead and write down the free cash flow yield of all the stocks you own and see if there's anything that looks pretty interesting out there, and then compare those yields to the 10-year Treasury. And if you're not getting at least a 3 to 5% premium above the 10-year Treasury, then you might not be getting paid enough for the risk of investing in an individual stock. Hey, in this floating little box next to my head, I did a video where I talked about return on capital employed, or ROCE. And you might find it interesting if you're a nerd and you like this kind of stuff. So Hit the thumbs up, click that floating little box, and if you do that, I will talk to you there.